Late last week, which would have been the end of July, we held our live event, the Accounting Bootcamp for Fall 2020. Unfortunately, we used a new platform, Microsoft Teams, and we used the live event feature, and I could not figure out how to record it, so I decided to go ahead and record a version of what we did in the boot camp so that this way I could post it online, and those of you that missed it will be able to view it anyway. So we'll get started here. Again, the purpose of this boot camp is really to kind of jar your memory a little bit, to get you thinking about accounting, to prepare you for Intermediate Accounting 1. You really need to hit the ground running, so to speak. The material that you're going to be covering is cumulative, so that whatever you learn on the first day, you're going to need all the way through to the last day of the course. Everything builds on what comes before it. Yes, there's going to be some new material, and the less familiar you are with the earlier material, the harder that later material will be to grasp and to apply. So trust me when I tell you that you need to be consistent in your work ethic in terms of how you approach the course and the material. And so in this boot camp, we're just going to kind of cover a few things that you should be bringing with you from your principles of accounting. Because I know some of you, it may have just been over the summer, it may have been from last spring and fall, or it may have even been longer than that. And so you'll be coming in with varying degrees of warmth towards the material. So I want you to have this as an opportunity to prepare yourself for the upcoming semester. Now, the first topic we're going to talk about is a real basic topic. It's accounting methods. There are two, okay, that we are going to deal with. Later on, you'll learn that there's a third when you start dealing with governmental. But for now, we deal with cash basis and accrual basis methods for accounting. Essentially, cash basis, when cash changes hands, that's when we recognize a transaction. So, in the example I like to use, if I'm purchasing a candy bar, at the time I purchase the candy bar, I fork out $2, I get my candy bar, the transaction has occurred. In a cash basis system, if the store owner lets me walk away with the candy bar, and I promise to come back tomorrow to pay him the $2, then technically a transaction has not occurred under the cash basis method. All that's happened is I got a candy bar, and the owner of the store got nothing. Okay? So that's important to realize when you're dealing with a cash basis system. It's all about the exchange. With accrual basis, it's events that trigger the recognition. And so the event, the fact that the candy bar changed possession, that the store owner released possession of the candy bar to me, that triggered recognition of a transaction. Even with my promise to pay tomorrow, the transaction is still recognized and is still going to be recorded. And he's still going to be able to record revenue for that transaction. But what he will record is something called a receivable. So I want you to get this into your head. This is the basic difference between the cash and the accrual basis. Is a cash basis relies on the exchange of cash to occur before you record something. In the accrual basis, it's the transaction that triggers. It's the event. Okay? Evidence for the accrual accounting system, if you're looking at somebody's books, you'll see things like different types of receivables, different types of payables. You'll see some accounts that are called unearned, and you'll see some accounts called prepaid. These are all evidences that an accrual basis of accounting is being used. An accrual, in simplest form, is about pulling something forward. A deferral is pushing it off into the future. And so certain transactions are viewed as accrual transactions, certain transactions are considered deferral transactions. So again, this is all about timing differences. So accrued revenues, this would be revenue that's earned now, but the cash is received later. And so this is what we would call accounts receivable. The accrued expenses is a payable. And so it's an expense that's incurred now, and we pay the cash later. So somebody has either given us something or done something for us, and it's actually occurred now. We have an invoice for it. We're going to pay it later. That's the payable. On the revenue side, the receivable side, we recognize revenue now because we gave something to somebody or did something for somebody, and we gave them an invoice, and we will get the cash later. So it's a timing difference between the parts of the transaction. So a deferred revenue, an unearned, which is a liability, and I'll explain that in a second, that's where we receive cash now, but the revenue is earned later. That's an advance payment. Somebody has paid me in advance to do something for them later, so that I can't really earn that revenue until I've actually done what it is I promised to do. So even though I have the cash in hand, if I don't follow through with my side of the bargain, then that cash must be returned. And since that is the case, it becomes a liability until I follow through and either deliver what I promised to deliver or do what it is I promised to do. Deferred expenses, prepaid, it's an asset. So that's cash that I paid now for something in the future. So this is where I bought something, either a good or a service that I'm expecting in a future period, and I paid the cash now. So that becomes an asset, because again, if I don't get what it is I asked for, what I ordered, then I will be able to get my cash back. So either way, I'm going to get something in return. So we call that a prepaid expense, and it's an asset. So all accruals and deferrals have two parts, an initial transaction and a subsequent transaction. The initial transaction would be, as an example, the sale of merchandise on account. When that transaction occurs, we increase our revenue, which affects equity. It increases an asset, the receivable. It decreases inventory, an asset, and we recognize cost of goods sold, an expense. So if you look at this carefully, the first item, the increase in the revenue, ties with the recognition of the cost of goods sold, so that we have our revenue recognition, which is our price times the number of units, all right, minus the cost that we assigned to those goods that we sold, the expense side. So you've got your revenue and expense. And then on the inside, you see the increase in the asset, the receivable, you're booking a receivable, and the decrease in inventory, you're recognizing that the finished goods inventory has decreased. And so the balance sheet stays in balance. And the net result is whatever profit you earned on that particular transaction. The subsequent event is the payment on the account. And so what will happen then is we will have an increase in an asset, cash. We will decrease the receivable because it's been satisfied. And then we will increase our operating cash flow because we now have received cash. And so this kind of links the financial statements together. You've got the income statement because you've got your increase in revenue and your increase in the expense, cost of goods sold. You've got an effect on the balance sheet because you have the creation of an account receivable, the decrease in the inventory, and then later you have the exchange basically of the promise to pay with the actual cash. So you have a decrease in one asset, an increase in another asset. That asset that was increased was cash, which ties to the statement of cash flows. So you're at that point able to show an increase in operating cash flows, which means that when we get into talking about the statement of cash flows, one of the things you're going to be looking at is the change in receivables and payables, because that's going to tell you something about cash received, versus cash paid out. Next, we're going to talk about the accounting equations. Notice I say equations, plural. That's because there are several of them that are very important, not just the one that you're familiar with. Everyone should remember the main one. So the one that we call the accounting equation, which we typically tie to the balance sheet, is assets equals liabilities plus equity. That can be restated any number of ways. And so we could have assets minus liabilities equals equity, or we could have assets minus equity equals liabilities. So it can be manipulated. The importance here, this is where your algebra comes in. These are all variables. Okay, you can know 2 of the 3 numbers and you could figure out the third. One of the things you'll learn is that each one of these are elements. Assets, liabilities, and equity are all considered accounting elements. And those elements can be broken down into sub-elements and eventually into individual accounts. Okay, and in those individual accounts, you can see where a problem can get nested, where you can have a blow-up where you can drill down into this equation, into its component parts, and have more complicated types of questions that you have to answer. But it all boils down to the same thing. Do you know which accounts go with which sub-elements, which go with which element in this accounting equation? Do you know what makes up assets? Do you know what makes up liabilities? And do you know what makes up equity? It's very important that you're able to drill down into these elements and understand all the way down to the account level, and you need to be able to go backwards and forwards from the element down to the account, from the account back up to the element. It's very important. One of the ways you can help yourself do this is to create some flashcards. That can be done using software, or it can be done the old-fashioned way. You just get yourself some index cards where you write the account name on one side and the element on the other side, and just quiz yourself. I also recommend quizzing each other. That is an effective way of studying, because this stuff has to be committed to memory. It has to become part of second nature as you move along. What I have found with students is that when they do not have that firm foundation, okay, if it's a crumbling foundation, if it's not even, maybe it hasn't set right, there will be problems as they build their accounting house on top of it. Okay? In some cases, it completely crumbles and falls apart. In other cases, it's just something where you're constantly having to repair and modify pieces of it. You want a firm foundation so that in the future, your accounting knowledge will be built on that solid foundation, so that you can be sure of your answers. Your clients and your employers will be confident in your knowledge about what you're doing. That is critical. Another accounting equation has to do with the income statement. It's revenues minus expenses equals net income. Of course, net income, what does that impact? Well, the income statement ties to the statement of owner's equity, or the statement of retained earnings. Net income increases retained earnings. What is retained earnings? We'll talk about that. One thing it isn't cash. Don't ever get retained earnings confused with cash. Don't ever get cash confused with retained earnings. The two are different. Okay? Retained earnings is a product of accrual accounting. Net income is a product of accrual accounting because of the way we recognize revenues and expenses. Remember, cash didn't have to change hands for us to recognize revenue or to recognize expenses. And so therefore, some of those revenues, some of those expenses did not involve the transfer of cash. So therefore, net income is not the equivalent of cash, and retained earnings is not the equivalent of cash. But this is an important equation all on its own. Revenues minus expenses equals net income. This is also the formula for a simplified single-step income statement, okay, which we will review later. Another accounting equation is for the statement of cash flows. You start off, remember, there's period statements and then there's point of time statements. The balance sheet is at a point in time. The income statement is a period statement. meaning it covers an entire period of time from beginning to end. I always equate it. Balance sheet is like a photograph, so it captures a moment in time. The income statement and the statement of cash flows are like movies. They have a beginning, a middle, and an end. Okay, so it shows you a progression over time, but it has a definite beginning and a definite end. Okay, so balance sheet, picture, point in time, income statement, statement of cash flows, period statements, has a beginning, middle, and end, and it shows a progression of change over time. With the statement of cash flows, we start off with the beginning cash, the cash at the beginning of the period. We want to be able to summarize, identify all of the increases in cash. We want to be able to recognize all the decreases in cash, so therefore we can confirm or calculate the ending cash balance. That ending cash balance, the difference between the beginning and the ending cash balance, netted against each other, is the change in cash for the period. What becomes important for this is being able to drill down into those increases and decreases and understand the significance of where cash came from and where it went. Because that's going to tell us something about the organization that we are studying. This is a generalized equation, too, that we can use for other general ledger accounts. So any account can use this beginning plus increases minus decreases equals ending. So if we have a beginning balance, anything that increases the account minus anything that decreases the account equals the ending balance. So this is a third very important accounting equation. So you have three. You're looking at assets equals liabilities plus owner's equity. You're looking at revenues minus expenses equals net income. And you're looking at the beginning account balance plus additions minus deletions equals the ending balance. Those three equations are the key to solving most quantitative questions in your accounting coursework. So here's another one. One final one for you, I believe. We have equity equals contributed capital plus retained earnings. So this is the balance sheet portion, and it's the equity portion. Remember, there's assets, liabilities, and equity. Equity is kind of the net assets. It's what's left after you subtract out liabilities. Liabilities, things, that's what you owe. Okay? Equity is what's left. It's the ownership claim. Contributed capital is what folks contributed to start the business and keep it running. That's the owner's contributions or the shareholder's contributions. So when somebody buys a share of stock, that becomes contributed capital. Retained earnings, that is your earned capital. That's based on operations. And so what you'll see is as you earn net income, that will end up increasing the retained earnings. If you have a net loss, that will decrease the amount of retained earnings. So retained earnings, you have the beginning plus your net income minus dividends paid equals your ending retained earnings. So when a company pays out dividends, where is it paying it out of? Well, two places. First, it decreases the amount of retained earnings you're going to report because it's sharing the net income with the shareholders. The other piece of it is it's real cash. And remember I told you retained earnings is not the same as cash. And so there's another piece of this. You have to actually pay out cash. So in order to pay out cash dividends, you need to have both a positive retained earnings balance and you need to have cash sufficient to pay the dividends. You can blow that up a little bit and show the retained earnings beginning is a function of increased by revenues, decreased by expenses, and further decreased by dividends, and gives you the ending balance. So essentially what we've done here is we have taken the net income portion and expanded it into its two component parts, revenues and expenses. This is important because you need to be able to think about this for any of the accounting equations. What are the overriding elements, the elements at the highest level what can they be broken down into, and what's their relationship to one another. So what we see here is that net income increases retained earnings. Why? Because net income revenues exceed expenses. So that difference between the revenues and expenses leads to an increase in retained earnings. If the expenses were higher than the revenues, we would have a net loss, and that would be a decrease to retained earnings. Dividends is a return that we pay to shareholders based on our performance. We perform well, we earn net income, we've got a positive cash balance, we want to give something back to those shareholders, and so we pay them a dividend on their investment. It is not a return of capital. We're not paying back some of the money that they gave us. We're giving them a return on the money that they gave us. So, assets. How can we break down assets? Okay. One, assets are cash and non-cash. So cash is pretty basic. It's the cash account and cash equivalents. There can also be a current and a non-current portion of cash depending on what the intention is. If the intention is to make it available for the current operating period, it's a current asset. If the intention is that we're going to hold that cash beyond a year, then it becomes non-current. In the non-cash assets, we've got current and non-current. So we have things like, in the current portion, we've got things like accounts receivable and inventory. We can also have short-term investments, and then, of course, cash that will be added to that. Then for the non-current portion of non-cash assets, we've got property, plant, and equipment, and investments. We also can throw in intangible assets, which are things like patents, copyrights, trademarks. Then for liabilities again can be broken down into current and long-term. Most of your current liabilities are payables. The long-term liabilities tend to be bonds and notes, so it's your long-term debt. The thing to remember about long-term debt is that some of the long-term debt will be paid off over time. When it's paid off over time, you have to analyze your long-term debt to figure out what portion is due in the current year, because that portion of it is going to be reclassified from a long-term debt to a current portion of long-term debt. So let's move from the equations to some analysis. This structure here that you're looking at is essentially how you would view transaction analysis. The top line, the top row, is your basic accounting equation. Assets equals liabilities plus equity. Underneath that, you begin to see the division between cash and non-cash assets. Liabilities, we really haven't broken it up there, but you can, between current and long-term. And then equity, it's between contributed capital and earned capital, which is your retained earnings. Again, drill down. Your retained earnings is a function of what? It's a function of your net income and dividends. And your net income is a function of revenues and expenses. Over on the asset side with cash, cash comes from three places: operating, investing, and financing. So it can either be a source of cash or it can be a use of cash in any one of those three areas. Operating, it's what you're in business to do. If you sell widgets, then it's based on the selling of widgets. Investing has to do with what's going on with your assets, generally your non-current assets, so your plant, property, and equipment. Are you purchasing it? Are you disposing of it, selling it? What are you doing with it? Financing is where you're getting your money from. Are you getting money by selling stock, or are you borrowing money? Okay, so that's operating, investing, and financing. And this will translate to the statement of cash flows. So in essence, this diagram right here lays out your balance sheet. It lays out your income statement. It lays out the statement of owner's equity or retained earnings, and the statement of cash flows. So this is kind of a neat diagrammed in one place where you can see the relationship between all the different statements and how they can impact one another. And again, we haven't even drilled down to the account level yet, because non-cash assets is made up of a number of different types of accounts. Liabilities, a number of different types of accounts. The equity section, a number of different types of accounts. Revenue and expenses, a number of different types of accounts. So again, the key is when you actually look at somebody's trial balance, it's made up of accounts. And if all the accounts were scrambled up, you'd need to be able to go through and reorganize them so that you can clump together the assets, the liabilities, the equity, the revenues, and the expenses. Now let's review the accounting cycle. And again, there's a number of different ways you can divide up the accounting cycle, but it's all the same thing. It's kind of like taking a snapshot of something, and different people can break it down into different components. So I'm breaking it down into 5 steps. Okay, there are some books that will break it down into more. It's all the same thing, but I'm just trying to keep it simple here. So the first step is to record something in the general journal. So you have some kind of an event that occurs. You analyze that event and determine, is it or is it not a transaction recordable in the accounting system? If you decide that it is, you're going to record it in the general journal. The general journal is the book of original entry. It is a chronological listing of all the transactions. It is just a chronological listing. So it starts January 1st if we're a calendar year company, and we start at January 1, we start recording all the transactions. Each period, probably a month, we're going to go through and we're going to take all those chronologically entered transactions from the general journal, and we're going to begin to post them into our general ledger. The general ledger is basically a folder with lots of other folders in it, and each one of those folders is an account. And so certain transactions can increase an account, certain transactions can decrease an account. We want to identify and classify each one of the general journal entries and then put it in its proper general ledger folder. And remember, for a journal entry, you need to have 2 accounts, a debit and a credit side, and we'll review that a little bit more. So that most of the time when you're posting to the general ledger, you're going to be hitting at least 2 account folders. The next step is, after you have done all the posting, is you need to adjust the general ledger. And so there's a process that you go through, and this is because of accrual accounting. Accrual accounting requires that we do an adjustment process on the general ledger before we do step number 4, which is prepare the financial statements. And once the financial statements are prepared, we do the closing process, which is where we close all the temporary accounts. And if you recall from Principles of Accounting, the temporary accounts are all the revenue and expense accounts. It's the accounts that are associated with the income statement. Because what's happening here is you are moving, at this point, you are moving your net income from the income statement to the balance sheet through the equity section, through retained earnings. Okay, and so that is the accounting process in a nutshell. Again, the general journal is that chronological listing of the transactions. It's the journalizing process. You're going to assign a tracking number, a journal entry number to each one of those. Then you will take that information and then file it, classify it, and file it in the general ledger system, which is a listing of each and every account for that organization. And so you go through the posting process where you post the journal entry to the ledger. So you're essentially tagging it into the individual accounts. So this way you can see the summary of what's gone on inside that account. You'll see all in the cash account. Every transaction, every general journal that impacted cash will show up in the cash folder in the general ledger. So it's the book of accounts. So again, an economic event occurs. You have to analyze that event and determine, is it relevant? Can we objectively measure it in monetary terms? Is it something that's going to affect the elements in the financial statements, the assets, the liabilities, the equity, the revenue, the expenses, the net income? Any of these elements, if it's impacted directly, then, and we can measure it in monetary terms, then we can go ahead and record it in the accounting system. An example I like to use or talk about is the changing of a corporate president. That is a huge, tremendously important event that occurs in major corporations, publicly traded corporations, and it can definitely affect the operating outcomes of a corporation over the long haul. It can have immediate consequences, but yet that's not something you're going to record in the accounting records. So it's an event, it's an important event, and it has accounting ramifications well into the future. But it is not an event that you're going to be able to record in the accounting records. But yet, people will look to try to predict how that change in presidency is going to affect the financial performance of the firm. So, but if we sold something, that's an event. That's something we're going to go ahead and record because it's relevant and it's objectively measurable. So changing of the president, no. Another one for you, issuance of a purchase order. We issue a purchase order. Has an event really occurred? Well, yeah, it has, but not an accounting event. Because all we've done is ask for somebody to send us something. We haven't gotten it, we haven't received an invoice, and so from an accounting standpoint, we don't actually record anything. Now, in the grand scheme of things, in the bigger picture of things, we do want to track our purchase orders. And so there are systems designed to track that. But it doesn't show up in the general ledger yet. Now let me go to the closing section here. Let's talk about closing for a second. Okay, these are the temporary accounts. It's all our revenue and expense accounts. We have the dividends account. You close all this out to retained earnings. Okay? Everything is closed out through retained earnings. Remember, we subtract the expenses, we add the revenues, and we subtract our dividends to come up with our ending retained earnings balance. The permanent accounts, those are our asset, liability, and equity accounts. Those accounts continue to move forward. So the closing process resets the income statement each year back to zero, so that for each period we can measure the new net income for the new fiscal year. The balance sheet is a historical marker account. It tracks from the beginning of the birth of a company, all the way through the death of the company. All the activity that's gone on, all of its assets, all of its liabilities, all of its performance over time is captured inside that balance sheet. Income summary account. This is a phantom account. It doesn't really exist, except in the accountant's mind and in the accountant's system. This is an account that we sometimes use to close out all of the temporary accounts. We can close out all the temporary accounts to income summary. It's just a check step before we actually take income summary over to the balance sheet through retained earnings. So it's something you might hear about. Just understand, it isn't really a real account. It is an accounting fiction. It's just a way for us to summarize the closing entries, put it into this income summary account. It's one extra step that we use to check ourselves before we actually hit the balance sheet and close out the books for real. Now, what are retained earnings? Undistributed net income history. That's what it is. We've earned net income over time. That part that we have not distributed as dividends are in retained earnings. Retained earnings is not the equivalent of cash. Why? Because retained earnings is calculated based on the accrual basis of accounting. Cash is cash. Cash, even in the accrual system, is cash basis, because it is dependent on the exchange of cash. Either cash came in or cash went out. Everything else in accounting is based on the accrual system, so that cash exchanging hands is not the key to recording the transaction. So since we have net income calculated using the accrual system, that net income and its movement into retained earnings means that that retained earnings change is not going to be equivalent to cash. So never get the two confused. Don't ever describe retained earnings as cash or money. It's not. It is merely a monetized measure of the historical performance of that firm over time. It is the undistributed net income history. Debits and credits. These are terms that haunt people that take accounting classes. They'll always remember the terms, but usually not with fondness. But they don't have much of a meaning. So we don't know really where they came from. Some people say they have Latin origins, but nobody's really 100% sure. So what are they? They just represent the left and the right side of a transaction. That's all it really is. So prior to this, we only thought of increases and decreases in accounts. And in one-sided accounting, you're highly likely to make mistakes. So this double entry accounting system allowed us to make sure that we had a way of doing our accounting that helped us check ourselves. It was built into the process. So debits and credits are just another way to represent increases and decreases by the type of account. And so it also allows us to recognize that accounts have something called a normal balance. What do I mean by a normal balance? Well, for an asset account, how do you increase it? Well, you increase it by debiting the account. That is on the left side. So again, if you're staring down at the account, you're looking at the left side, right side. Left side is the debit side, right side is the credit side, and then you've got your normal account balance is whichever one is supposed to be the larger. Whatever the balance is supposed to be, that's the normal. So for cash should never be negative. There's no reason to have a negative cash balance. So you'd never want to have a credit cash balance. That would be abnormal. Normal would be a debit balance. Okay? Liabilities, same way, except just the opposite. You would expect that since you have to offset assets and liabilities, they could not have the same debit balance. Okay? What you need to do is you need to have a credit balance in liabilities to offset against the debit balance in assets. So you can see that liabilities, contributed capital, retained earnings, revenues, all have credit balances as their normal balance. Assets, expenses, dividends, all have debit balances as their normal balance. Now, I've been ignoring two items on here. 3. Contra asset, contra equity, and contra revenues. Example, contra asset would be accumulated depreciation. Okay? We net our capital assets minus accumulated depreciation. Accumulated depreciation shows up in the assets section of a balance sheet, but yet it is behaving exactly opposite of the other accounts in the assets section. So it has a flipped sign on it. So rather than being increased by a debit, it's increased by a credit. Why? Because it has to offset the asset account that it's attached to. Another one is the allowance for doubtful accounts, which is attached to receivables. Receivables are increased by a debit. In order to be able to decrease that account, you need a credit. And so the contra asset account, allowance for doubtful accounts, is a credit-based account. And that's the way all of these contra accounts work. They attach themselves, they are attached to specific accounts in the system, and they behave in the opposite manner. Okay? They are designed so that we don't overstate something. We never want to overstate or understate. We want to get as close to what we really believe the real number is. Because remember, financial statement reporting is not for internal use. It's for external users. We are trying to provide the most up-to-date and most accurate, complete information possible to those people that are having to make capital distribution decisions, whether it's purchasing stock or issuing loans or purchasing bonds. We want them to have good information to work from so that they can make the most appropriate decision for their circumstances. Journal entries and posting. Remember that the accounting equation must always balance. Both sides must be in balance. So every transaction will affect at least two accounts. So you can have, say you have assets equals liabilities plus owner's equity. So if you increase an asset, you're going to have to increase something over on the other side of the equation. If you decrease an asset, you're going to have to decrease something on the other side of the equation. Or you can have a transaction that affects only one side of the equation, but then you must have an increase and a decrease on that side of the equation. So for example, the settlement of accounts receivable. The settlement of an accounts receivable decreases the accounts receivable account and increases the cash account. So the asset side of the equation stays in balance. All that's happened is that the character of an asset has changed from less liquid to more liquid. You move from an account receivable to cash. The original sale that generated the revenue, okay, what we saw there is we saw that that did have effects on both sides of the equation, because we generated an asset, an account receivable. At the same time, we had a decrease in our inventory. At the same time, we recognized an expense, cost of goods sold, and we also recognized revenue. And so there we had multiple accounts involving both sides of the accounting equation, but the whole accounting equation stays balanced. The net amount of a journal entry should always be 0. And so here, in this example, if we were to purchase land and increase the land account, and we paid strictly cash for it, the amount of cash should equal the price that we paid for the land. The net amount of that journal entry should be 0. Now, posting to the ledger. What does that look like? Again, we have debits and credits in our typical T account, and so we have a beginning balance of cash of $100. A customer made a payment of $25,000 to us. Well, that's a debit. It's an increase to the cash account. At the same time, or during the same period, we made a payment to our supplier. We owed them $10,000 in cash. We paid them $10,000 in cash. And so that goes in the credit column. So then what's the ending balance in the account? Well, we just net it all. So it's 100 plus 25,000 minus 10,000 equals ending balance $15,100. And that $15,100 in the cash account should show up on the debit column. If, as an auditor, I was to come in and I was to look, that's one of the first things I'm going to scan for. I'm going to look for accounts that have non-normal balances, because that to me indicates that there's a problem, something that we need to look at. Now, this is an important topic, adjustments, because you can't get your financial statements correct if you don't know how to do your adjusting process. And so while the purpose of this isn't really to teach you how to do the adjustments properly, it's to get you ready to learn how to do them properly. Okay? So let's take a look. First, the process of updating the financial records in advance of preparing the financial statements is what adjustments are all about. We're trying to get them ready so that this way we get good financial statements. It is a subset. The adjustments are a subset of our accruals and deferrals. Not all accruals or deferrals are adjustments, only those occurring at the period end. So updates are necessary to recognize all financial statement items in the correct period. So, for example, say we paid rent in advance, and say we paid for 2 years of rent in advance. And so maybe we paid $24,000 at $1,000 a month. We paid all that up in the first of the month of the year, say on January 1st. We've gone through the whole year, okay? we haven't done anything with that. It's in prepaid rent. Okay, so it's a prepaid rent account. So what do we have to do? Well, we need to adjust that account. We have now used up 1 year of rent. And so that $24,000 is really overstated in the prepaid rent account. We need to recognize some expense there. And so what we're going to do is we're going to decrease the prepaid rent account by $12,000, and we're going to recognize $12,000 in rent expense. That can be done as an adjustment. Now, it can also just as easily be done as a regular journal entry each period, but in some cases they treat it as an adjustment. Some less sophisticated accounting systems will treat those as adjustments. Another example, salary. Not all salary payments occur neatly within the boundaries of the fiscal year. So sometimes people can earn money in one fiscal year and get paid in another fiscal year. So what are you going to want to do? Well, you want to make sure that that expense is recognized in the proper period. So if a pay period crosses over a fiscal period, say it's a 2-week period and 1 week occurs in year 1, 1 week occurs in year 2. You want to take that year 1 week and recognize it in year 1. And so you're going to do an accrual entry. You're going to accrue that expense in that particular year. So you're going to take 1 week's worth of salary and record it as a payable and as an expense in year 1. And it will all balance out in the end when you go to pay it. Because when you actually pay the full 2 weeks salary later, you're going to recognize the additional amount of expense, the additional week. It'll be recognized in year 2 when it's supposed to be recognized. You'll also have the transfer of cash to the employees. And what you'll have is the settlement of the liability. You had created an account payable to the employees, so wages or salaries payable, that facilitated allowing you to recognize salary expense in year 1. You'll settle that payable, you'll decrease that liability later in the next period when you actually make payment to the employees. And so this way, half of the payroll is recognized as expense in year 1, the other half is recognized as expense in year 2. That's the way the adjustment process works. It's meant to make sure that all revenues, all expenses, all assets, all liabilities are recognized in the year or the period that they're supposed to be recognized in. That's the whole purpose. It's like, when you're dividing up food, trying to make sure that everybody gets the same amount. You're trying to make sure you're going to measure it as carefully as possible. Sometimes you'll use a little scale and weigh things out and say, you get so much, you get so much, you get so much. Well, that's what we're doing with the accounting periods. Trying to make sure that a fair share of the amount of things are allocated to each individual reporting period. So some of the accruals that you will deal with are going to be for wages, utilities, or benefits received prior to payment. Okay? So the bill is going to come later. We're going to want to accrue that at the end of the period. Deferrals are things like your prepaid expenses and unearned revenues. So in the case of the rent, that was a prepaid expense. So we had to look at that account to make an adjustment. These are going to be the keys. How do you know what adjustments to make? Well, you're going to have to look at certain accounts. So things like wages and salaries, things like utilities, things like rent, anything that's prepaid, unearned, or that's subject to accrual, estimates, estimates like the bad debt expense, tied to the allowance for doubtful accounts, the depreciation expense versus accumulated depreciation, those estimate accounts, you're going to have to look at those carefully to see whether any adjustments are going to be necessary. So deferrals involve allocation between periods. Again, so another example is the payment for insurance coverage, similar to rent. We often pay for insurance up front, so it becomes a prepaid expense. We're going to use it up over time. And so whether we do it on a month-to-month basis, it's just part of the regular monthly closing process, or whether we do it just on an annual basis, we're going to have to recognize a part of what we prepaid for insurance as insurance expense, and the balance of it will still be an asset on the books as a prepaid expense. Sorry about that. Throat gets a little dry. So now let's take a quick walk through the financial statements. It's just a way of reviewing the financial statements here. So again, we're dealing with three common business types: service, merchandising, and manufacturing. Each one gets a little more complex in terms of the level of detail that's recorded in the financial statements themselves. And they kind of go in order. Service are kind of the easy ones maybe to work with. Merchandising, a little bit more difficult because we now have inventory that we're dealing with. Manufacturing, much more difficult because now we've got a manufacturing process and we're dealing with multiple types of inventory. So the merchandising, we're dealing with inventory purchased and marked up for resale. In manufacturing, we're dealing with the purchase and inventory of raw materials, what we have in work in process, and then finished goods inventory. When you learned in Principles 1, you really were spending a lot of time between service and merchandising. In Principles 2, you moved into manufacturing. And so you've been exposed to all three of these types of businesses and the issues that are involved. That will be at play in intermediate accounting as well. So you're going to need to remember those. We typically call a balance sheet a classified balance sheet. And why we call it a classified balance sheet is because we put everything into classes. So we have assets, and then we have current assets and non-current assets. In the current assets, we order them by liquidity. So cash is already liquid, accounts receivable is next, inventory, and prepaid assets and supplies. So that would be kind of the order of liquidity. Then your other assets that you have, your non-current, would be things like investments, plant, property, equipment, which are your tangible assets, and then your intangible assets, which are copyrights, trademarks, patents, and so forth. Over on the liabilities side, you've got your current liabilities, and essentially that's a bunch of the different payables. And you can have any number of payables, classify them, give them account names that make sense to you as a company. You get to decide that. Then you've got your unearned revenues. Those also will likely be current liabilities. Your long-term or non-current liabilities are going to be things like your notes payable, bonds payable, and pension liabilities. Again, the key here to remember is that there may be a current portion of the long-term due. And so you have to look at your long-term liabilities and determine whether any of it needs to be reclassified to the current side of the liabilities statement. And then you've got equity, which is basically divided up again into contributed capital and retained earnings or earned capital. Now the income statement, you've got two different types. You've got the simple single step, which is just your revenues minus expenses equals net income. And properly formatted, that's all it looks like. You gather up all the revenues, add them up all together, and then you gather up all the expenses and subtract it from the revenues and calculate net income. It's a quick and dirty way of reporting net income, but it doesn't give you a lot of information about the income being earned. The multiple step gives us a view down into where our income is coming from. So in here, the multiple step is going to be sales minus cost of goods sold gives us our gross margin. So that's kind of your first step. The second step is to subtract out all the operating expenses, your selling expense, your general expenses, and your administration expenses. You subtract all those out, and you end up with operating income. Then you'll have other miscellaneous revenues and gains and other miscellaneous expenses and losses. Popular ones are things like interest revenue, interest expenses. Once you factor those out, you'll have income before taxes, or income before income taxes. You'll calculate your income taxes, take that out, and then you finally have net income after taxes. And so what that allows you to do is over time, you can now track where net income is being generated. Is it coming from one-time occurrences in the other revenues and other expenses area? Are you Are you affecting income by playing around with your selling, general, and administration expenses? Are you having any problems managing your cost of goods sold? Or are sales increasing or decreasing all on their own without any other adjustments occurring later on in the multi-step income statement? From an analytic standpoint, this is a much stronger presentation than the single-step income statement. So again, the multi-step income statement provides much more detail to the users. So we've kind of reached the end of the boot camp here. I normally do this in about 2 hours, but this I've done in 1 hour. I've got 2 examples I'm going to work through next. But first, in final thoughts on the class is try to relax yourself as you navigate intermediate accounting. Keep a clear mind. Always ask questions. We're here, your professors are here to answer your questions. We want you to ask questions. So try not to get anxious and upset that you don't understand something. Sometimes we don't understand your question. That's completely possible. And so be patient with us. We'll be patient with you. And be persistent. Keep asking. Don't give up. Okay? Because we won't give up on you. And keep to a schedule. It's really important that you manage your time well. Start off strong. The stronger you start off, the better off you will be throughout the course of the semester. Trust me on this. I've been there. I know. It can be really hard. I've had good semesters, and I've had bad semesters. When I have a bad semester, it's usually because I got off to a slow start. When I have a good semester, it's because I got off to a quick start. So trust me when I tell you this. Buckle down right away first week and dig into the coursework and get it done. Now, what next? Let's take a look at an example. So I have Dilbert's tree trimming. First, I'm going to credit David Krug, who teaches at Johnson County Community College in Kansas. Has some really great resources online. And so I've kind of adapted this from some of the work that he's done. I've renamed some things. Dilbert's Tree Trimming is a sole proprietorship owned and operated by Wally. If you're a Dilbert comic fan, you'll understand those names. The next slide contains the accounts for August 31st, 2020. Accounts are in alphabetical order. You're to prepare an income statement, a statement of changes in owner's equity, and a balance sheet. Prepare them in proper form. So here are our accounts. We have accounts payable, accounts receivable, advertising expense, cash, equipment, Wally's withdrawals, Wally's capital account at the end of July, gasoline expense, miscellaneous revenue, salary expense, supplies, trimming revenue, and unearned revenue. Your first task here is these are in alphabetical order, I guess. Maybe not. But they're in some kind of order here. You need to reorder them by financial statement. Which things go on the balance sheet, which things go in the income statement. That's the first thing you need to do. Once you do that, then you need to figure out, let's just do a single step income statement and see how it goes. So when we come here, this is kind of a properly formatted income statement. Easy to put together. I did this in a table in Word. And so I have the name of the company on top, the statement, income statement, and for the month ended August 31st, 2020, it's a period statement. So for the month ended, shows that it's for the monthly activity. I start off with the trimming revenue of $7,800. I add to that the miscellaneous revenue, so I show total revenue of $8,200. Then I have my salary expense, my gasoline expense, and my advertising expense. So my total expenses is $1,160. And then I show my net income before taxes of $7,040. So it's that simple. This didn't take me long to put together. Using the software, you put something together, I guarantee you your professor will be very pleased with you if you do stuff like this. It makes life so much easier to grade, to follow along, to identify problems if presentation is taken seriously. So now that we have our net income before taxes, remember in the previous slide, we had Wally's withdrawals and Wally's capital. That's the that is our statement of owner's equity right there. So next we can kind of tackle that. We can do the statement of changes in owner's equity. So his capital account started out on 7/31 as $28,000. He withdrew $3,500, and then he reported net income of $7,040. So the net amount is now capital account at 8/31/2020 is $31,540. And so this new capital account becomes a part of the balance sheet. So this moves on to the balance sheet. So we're then able to move and plug in our numbers into the balance sheet. And so here what we have is we have our, again, properly formatted, 3 lines, name of the company, name of the statement, and the period. Notice it says at August 31st. That's because it's the snapshot, the picture on a specific date. So our current assets, cash, $17,730, accounts receivable, $4,240, supplies inventory, $4,200, total current assets, $26,170, non-current assets, we have equipment at $78.50, so our total assets are $34.20. Now, total liabilities, total equity, if we did everything right, should equal that. So we have our current liabilities, accounts payable, $2,100, unearned revenue, $380, total liabilities, $2,480, and then when we plug in the number for equity that we got when we did the change in owner's equity, all right, lo and behold, we end up with total liabilities and equity of $34,020. So we can feel pretty good about the work that we did in coming up with Dilbert's Tree Trimmings financial statements. We're in good shape there. Okay, so this is just a brief kind of exercise. What you can do is when you get to this slide here, oops, when you get to this slide here, stop and try to put it together yourself and see if you can do it. And if you do it on paper, fine. But I would also recommend opening up a Word document and a set of tables and doing it up yourself. Make it look pretty. Use the examples in the book that you have for proper formatting. You know, formatting can differ a little bit to a certain degree, little things, but there's some things that you're going to want to use. Underlining, double underlining. Double underlining means we go no further. Double underlining indicates that the buck stops here. Single underlining usually indicates that we've got some kind of a subtotal there. Okay? Sometimes they use indenting. For example, let me go back here to the balance sheet. Notice I've used some indenting here. Okay? That could just as easily have been used in here as well. We could have indented certain things. All right? We didn't because it's a one-step income statement. If we had done a multiple-step income statement, we would have used some indenting there as well. The last item I want to go through is kind of our transaction analysis, our transaction and journal entries. So, journal entry number 1. And again, I was a big fan of cartoons. I still am. I'm a kid at heart. So, I apologize in advance if you think it's kind of corny. On May 1st, Bugs Bunny contributes $4,000 cash, as well as an automobile valued at $6,500 and equipment valued at $700 into his business. First thing you want to ask yourself is what's going on in this particular transaction. The answer that should come to your mind is he's capitalizing a business. Capitalizing means he's putting money into a business. He's getting it started. Or if it's a business that's already been ongoing, it may need more capital, and he may have it available himself, and he contributes that. So rather than going and getting it from somebody else and having a partner or a shareholder, rather than going to the bank and borrowing the money, Bugs is just going to put it in himself. So what does that journal entry look like? Again, use good form. Okay? Make sure that all of your debits are lined up and all of your credits are lined up, and debits should come before credits. They should all have a date. So this all occurred on May 1st of 2020. And so we debit cash, $4,000. We debit the automobile account, $6,500. Again, that's an asset account, so it's going to be a non-current asset account. And then equipment for $700. And then we credit Bugs' capital account for the total of $11,200. We've got a journal entry. It has at least two accounts, one debit, one credit, right? And it balances out to zero. So we've met the requirements here. And everything's been recorded. So we now have cash on the balance sheet. We've got some property, plant, and equipment on the balance sheet. And we've got equity on the balance sheet. So what does Bugs do next? On May 4th, Bugs buys some office supplies at Office Depot for $180 cash. So what that transaction will look like is a debit to office supplies, and that's office supplies inventory, and a credit to cash for $180. So we've exchanged one asset, cash, for another asset that we need, office supplies. Now, sometimes office supplies will just be office supplies expense. It depends on whether it's material or not, and how quickly the office supplies are used up. I would recommend most of the time creating an office supplies inventory and then doing a count of this office supplies inventory at the end of a reporting period and recognizing the appropriate amount of expense and then showing the amount remaining of office supplies inventory on the books. Again, it's going to depend on just how material it is and what, if you were running the business, your accountant would make a recommendation as to how best to handle the situation. On May 11th, Bugs provides services worth $200 to a client, Elmer J. Fudd. The client immediately pays $125 in cash to Bugs, but Elmer will pay the remainder at a later time. So we now have somebody owing us money, which means we have an account receivable. So when we record this transaction, we're going to debit cash for the $125 that Elmer paid us. We're going to book the account receivable for $75 that he still owes us. And we're going to be able to recognize this all of the service revenue, $200, we're going to be able to recognize right now. Remember, under the cash basis of accounting, we would have only been able to recognize the $125. The $75 would not have been recognizable at this point in time. It could not be recognized until he paid us the $75. So that's the difference between cash basis and accrual basis. Accrual, we can recognize the revenue now, and we can put the receivable on the books. Cash basis, we can't. Journal entry number 4. On May 12th, Bugs purchases some more equipment for $5,000 by making a down payment of $500 cash and setting up a note payable for the remainder. And so here we're going to be creating a liability. So we purchased more equipment, we paid part of it in cash, so we've exchanged one asset for another type of asset, and we've also created a liability. So that journal entry will be a debit to equipment for $5,000. We'll credit the cash account, $500, and we will credit notes payable for $4,500. So the idea here is that we've increased an asset account, equipment, we've decreased the cash account for the down payment, and we've increased the notes payable by $4,500. So notice that the credit to cash, which decreased cash, we have a credit to the payable, which is a liability, which increased the liability. That's that normal balance concept. Cash's normal balance is a debit balance. The credit balance shows a use of the cash, a decrease in cash. The liability side, it's the normal credit balance. So when we're increasing the account, we're going to be crediting it. So that notes payable credit shows an increase to notes payable. So that's the application of the normal balance. Journal entry number 5. On May 22nd, Elmer, our client, pays the remainder of the money he owes to Bugs for services rendered. So again, remember we created a $75 accounts receivable. So the only thing that's going to happen here, the revenue was already recognized, so we don't recognize it again. All we do here is we satisfy the receivable. So we show the deposit of cash, $75, into the cash account, and we take the receivable off the book, $75. So now our accounts receivable balance is zero because Elmer has paid it off. And what did we get? We now have a total of $200 in cash. Okay? Well, minus the $180 we paid for the office supplies and the $500 we paid, which came out of the cash account. Remember, he originally put in some cash as well. And so you could create a T account for cash and actually show the effects of each of these transactions on a single account. So if we go back to the original entry. He started with $4,000 in cash. So that would be the opening balance is 0. We show the deposit of $4,000 in cash is a debit to the cash account. Okay. Then we have a credit to the cash account for $180. Then we have a debit to the account for $125. So we have a debit of $4,000, a credit for $180, a debit for $125. Then we have a credit for $500 and a debit for $75. And so that's your general ledger. So this is the general journal where we're posting journal entries, or we're journalizing. So we're recording journal entries, and then we can post the ledger. And so if you use the cash account, you can track all the debits and all the credits and calculate what the current balance of cash is. And that's the beauty of double entry accounting and the use of multiple books to help us in managing accounting information. Again, it's really important to remember accounting is an information science, or it is a way for us to track or manage performance of a firm. And whether that firm is a business, whether it is a not-for-profit, or whether it is a governmental organization, we use accounting as a means to determine basically financial performance. How have they done? So it is a performance measurement information system. That's how you need to view this. There isn't a great mystery behind it. It's not intentionally made to be difficult or inaccessible. It's just there are a lot of rules to remember. And you'll get into those rules. In intermediate accounting, you'll spend a lot of time at the beginning of the semester learning about the rule-making process and how political it can be. So you have to pay attention to the rules of the game, because this isn't like physics or chemistry where the laws of nature and the laws of chemical properties and the laws of physical properties, they don't change over time. They pretty much stay the same. But in accounting, the rules of the game change, and they change because people change the rules. And it's a very political process, so it's highly subjective. And I think that's one of the things that makes people uneasy about it. How you recorded something today, a couple of years from now, it may not be the same way. Why? Because they changed the rules. So just remember that that's the way this works. And if you relax yourself, look at this as a fun exercise. Accounting can be a very good field to get into. It's going to take care of you if you take care of it. So I encourage you again, get off on the right foot. Get to work right away in that first week. Try to schedule time. I know everybody's busy, but trust me, the better you are at managing time, the better you are at allocating time to your studies, the better off you will be over the course of your academic career, and that will help you in long term in your professional career. So, anyway, so this was the boot camp. We did it in about 2 hours. Here we've done it in just about an hour and 15 minutes. And so if anybody has any questions, of course, you can always email myself at cgabrini, that's C-G-A-B-R-I-N-I @daltonstate.edu, or you can reach out to Professor Haverland at bhaverland, Haverland @daltonstate.edu with any questions, and both of us will be happy to answer them for you.